Hey, so you've been a wonderful audience, and we've eaten all our meat and potatoes, and now it's time for dessert. We are extremely grateful to the Comptroller of the Currency for joining us this afternoon. He's had a busy couple of days on the Hill, and so we really appreciate. I wasn't up there, I don't know. It should, try it now.
Testing, thank you.
So we're particularly appreciative with your busy schedule that you're able to make time for this.
My pleasure.
And we're also deeply appreciative for the priority you've given to CRA and modernizing it. I think it's maybe unanimous in this room that that is long overdue. And so we really appreciate your making the time and energy and priority to really do this for the first time seriously in over 20 years. It's hard to believe. And
how time flies.
How time flies. And I guess you've been in banking for longer than that and experienced CRA. And tell us, as a banker, what your experience with CRA was.
Yeah, well, first of all, it's a pleasure to be here. I know it's kind of late in the day, but it sounds like you guys have had a really action-packed day where I think these kind of events are great because you bring people together and you're able to go back, learn things, and redeploy those in what you're trying to do for America. I was a banker for 34 years, and I can tell you, never in my wildest imaginations did I think one day I would be sitting here in Washington, D.C. being the Comptroller of the Currency, but it just goes to show, things work out. I would say, CRA brought me a lot of probably the greatest moments in my banking career. When I was able to go into the communities across America where I was able to be a banker and see dreams become reality, where people had thoughts that could be done, and then we helped them put those dreams into realities and the things that they did for communities. And I would say that was probably one of the more rewarding things that in my banking career is that we allowed people to chase their dreams and we helped those people with those dreams. And so for 34 years, and really 24 of those 30 years, I was really actively involved in CRA. I was responsible for a big part of the CRA when I was at US Bank. And then I left US Bank and I went to One West Bank, and I would tell you I really ran the CRA program as the CEO of the bank because it was that important to me that we needed to have the proper outreach in the community. And I think we all know when you have senior management involved in something, it just seems to have a greater focus and momentum, I think, in any particular organization. I was a user of CRA, I was a builder of CRA, and I helped people be the beneficiary of CRA. And one of the things that I think when people hear about my agenda items, there's really three things that we have focused on. We focused on CRA, we focused on how we can improve, but also look at the Bank Security Act from the standpoint of how we can make it more effective. And the third is small ticket consumer lending. And people will say to me, boy, 2 out of the 3 items that you're really focused on fits right into the people in America that need the most help. And I think that goes to tell the story a lot about why all of you are here, is you're really trying to help people across America. I think there's 3 things that we have to try to solve with CRA. The first being, even as an executive who would spend all my energy on CRA like I used to, I still didn't know when a group of bankers or examiners were going to show up if we were going to pass our CRA exam. I mean, it's a very complicated thing. It's a relative to your market. Sometimes products that we thought were going to qualify did, sometimes they didn't. And so the first thing that we really want to try to create is some way to measure CRA on a more consistent basis. There are some people that like the current model, and we're planning in the next couple weeks to issuing an advance notice of proposed rulemaking. If you've got great ideas about the way CRA is working today, bring them forward. We're all about improving it. I also have another framework that is an alternative to that, and that's like picking a balance sheet item would be my kind of, if I was king for the day, and I would pick either total deposits or tier 1 capital or total assets, and then I would add up all the CRA activities an institution did, and then I would just compare it. And so like as an example, If you're a $1 billion bank and you do $100 million in CRA, if you divide it by that $1 billion, it says that your institution has 10% of their assets dedicated to CRA activity. And that could then universally be applied whether you're a small bank in my hometown in Maquoketa, Iowa, or to One West Bank into Los Angeles, or JP Morgan sitting in New York. And at least we would have some relevance to how banks are doing CRA in relationship to their balance sheet. The second thing that I really feel that we need to spend a lot of energy, and I think your thoughts in this area will be important, is we need to broaden the category of what qualifies for CRA. I mean, for all practical purposes, most of the category today is single-family mortgages and multifamily housing in low to moderate income areas. And that represents about 75% of CRA. And I'm a big believer we have to kind of expand small business lending. Today, if a company gets up to $1 million, if it's $1.01 million, it can't qualify as a CRA loan. I think if we have a business in the inner city of one of the cities in America, and it's $1.25 billion, and it's going to create 30 jobs in an economic disadvantaged area, we should count that as CRA. I also feel like if you look at most churches across America today, I understand the difference between church and state, but if you specifically look at the Black and Latino churches across America, they are the place that people goes for job training and financial education. And for the most part in CRA, when anything comes up with a church on it, it kind of gets excluded. And so I think you should be able to figure out what portion of that church organization is supporting its community, and let's include that as well. And there are lots of examples like that. And when we put the advance notice for proposed rulemaking on, we really want your ideas. Someone called me today and just had a brilliant idea, which they said was, you know, what's the biggest problem in inner city America today? And I said, John, it's jobs. And he said, right, but where's it most acute? And I said, well, I don't know. And he says, it's 18 to 22-year-old. And he said, well, how about if we make CRA qualified, that if companies would have internships or apprenticeship, that we would make that CRA qualified? I'm like, that is a brilliant idea. So we need those kind of ideas to come forward. And then our plan is to kind of create a list for banks to be able to say, here's all the things that would qualify for CRA. And then if you have a new idea, bring it to us and we'll tell you up front whether we think that qualifies or not. The third big issue that we're trying to solve for is we do CRA exams every 3 years. And at the end of the third year, we do that exam. Excuse me. And then it usually takes us 6 to 24 months because of the complexity of the measurement to issue a CRA report. I'm a believer if we can get the first part fixed where we can get to a more objective measurement system, that I think what we would have the ability to do is we'd be able to almost perpetually tell a financial institution if they're in compliance with CRA. And I think that's the third big goal to that process. I think one of the big challenges that we're all going to have to talk a lot about in CRA is the issue around the assessment areas. Today, for the most part, an institution will pick an assessment area where most of their branches are. But I'm also fearful today that the way we have assessment areas established, that we eliminate opportunities that banks could do. Because I'll give you an example. When I was CEO of One West Bank, we had branches in Los Angeles, so we picked Los Angeles as our assessment area. But we also had branches in Ventura, Inland Empire, Riverside, and Orange County. But if something was on the wrong side of the street between the county line of Orange County and LA County, on one side of the street we got credit and the other side of the street we didn't. And so I think we need to think through how do we do assessment areas. The second thing is I'm a big believer in protecting the assessment areas around the branches, which are predominantly where banks have their customers. But I think we also have to look forward that there are certain banks that don't have branches, and there are certain banks that have branches but also are growing their kind of online. And I think we need to think through, well, you know, where you have your customers is important. So if you have branches but you have all really of your customers somewhere else because you're doing internet banking, then I think you have to kind of swoop in kind of where we got your customers and kind of make it a holistic approach to what I would say is assessment area. And that's another area when other than what products qualify, I think we're going to have to put our best heads together and talk about assessment areas and try to figure out how do we thread that needle that we don't walk away from what historically has been an assessment area around a branch network, but also with a view towards what the future looks like. And somebody else has told me, you know, look, we don't have employees or we don't have branches in a certain area, but we have 2,000 employees. I want to be able to support my employees' activity into that community. And so figuring out all these nuances is, I think, the real opportunity that we have ahead of us with CRA. So,
yeah, that's great. So we talked a little bit about small business lending as maybe changing the thresholds, or maybe even in low-income communities, going maybe even beyond small businesses to larger businesses.
Yeah, I don't think you're ever going to go to large business on the lending side. I think on some of the service-related items, I think there's a lot of creativity around the service side that companies can do donations or finance projects or initiatives that where they donate money, that I think would probably be, you would see that more in the larger company. What I was referencing today, if on a CRA qualification, if a business has $1 million of revenue or more, then they can't qualify for if somebody makes them a loan for CRA credit. So.
And there are some, this is sort of typical of the complexity, maybe excessive complexity of CRA. There are some rules in a community development context where you can use SBA definitions and the like.
That's right.
But the one thing we hear from our bank members more than anything else is predictability.
That's right.
And just knowing what counts, where it counts, so that they know at the time they're making a financing, whether it's very likely to get CRA consideration. And for our nonprofit and mission-driven members who partner with banks, they have the same concern.
I agree. I mean, it's kind of goofy when you really think about it, that make an investment and then we'll tell you in 3 years if it's going to qualify. So.
I wish I had a nickel for every time I heard that from my members.
Right. So, I mean, you can hit the bullseye most of the time if it's single-family housing or multifamily and a low to moderate. But I think what you really want, you know, I really believe banks want to do more, communities want to do more, politicians want people to be more, community organizers want people to, let's figure out a way for that to happen.
So there are a variety of different banking models. Some of our banks are really focused on the areas around their branches. Others are entirely branchless. Others are a little bit of a hybrid.
That's right.
How can one sort of view of CRA encompass all of that?
Well, I think, you know, the core issue really is how are you serving your community, and how are you funneling resources, including capital and personnel, to serve that community. And that's where it gets back to this issue around assessment areas. Mm-hmm. It is a tricky thing to think through. I don't think anybody has all the right answers on that yet. And it's going to take a lot of, I think, critical thinking about that. Is don't give up what we have, but the world is changing. Mm-hmm. And how do you make that transition from, we want financial institutions to support activity around their branch network, with a view also to what the world of banking is going to look like in the future.
So would you think of CRA as a sort of a zero sum, where an activity outside an assessment area means less will go to assessment areas, or that this is really more of a positive sum where banks could get more consideration for doing more?
I think, well, definitely it's not a zero-sum game. You know, often finding the product is the big challenge that banks have today, is finding enough investments or lending activities within their defined assessment areas. If you could say, okay, we still want you to do that, but we're also going to give you credit if you do something, if you have branches and customers next door, I think would open up a lot of opportunities for finance. My experience as a bank CEO, I struggled finding product. And this other part about, you know, the issue of a mortgage pool being, you know, kind of created and then traded 5 times, and each bank got credit, you know, is something I think we need to look at hard. Because when you talk about zero-sum game, if somebody originates a loan book in a low to moderate income neighborhood, and then that trades 3 times over the life of that portfolio, and every bank got credit, not one extra dollar reached the community, but the institutions got credit for that in their CRA stuff. Now, I do understand sometimes people originate stuff so they can sell it, but I think you have to limit how many times that can get qualified. Maybe it's the originator and the first buyer, and then from that point on, you don't attach, they can still sell it, but it can't attach CRA qualifications with it. So I think if we do this right, most institutions that I know are excited about putting more money in the communities to which they operate, and they want to do that in a partnership with community groups and CRA.
Yeah, we do too. I hear all the time that banks want to do more, but unless they can be fairly sure that something's going to count for CRA, they have to devote their focus to things that they know will count.
That's right.
And so I think getting more clarity around what counts and where it counts would unleash a lot of capital to benefit communities and their residents.
Right.
You talked about the trading and retrading of mortgages or mortgage-backed securities as something that maybe ought to be a little bit more constrained. Are there other things you think that are getting credit now under CRA that should get less consideration?
I don't. The flip of that, though, is we, in our early stages of creating the advance notice for proposed rulemaking, is our thought is we were looking for things that we thought the risk, if you make a loan or you make let's take a dollar loan or a dollar equity investment, this dollar of equity is much more at risk. And so the thought is in the ANPR is to say an equity investment like in a CDFI, let's just use, if I make a loan to a CDFI and I put $1 in, it's $1. If I put $1 of equity into a CDFI, I'll get credit for $2. Mm-hmm. And that's the only, but we're going to ask people again, help us think about where a multiplier to encourage people to make those investments on the equity side would make sense. And I think, again, that comes from people providing us ideas. But I think if you think about those kind of things about where is there a need, where is the risk greater, and where can we reward people by some type of stimulus, meaning 2 times for every dollar.
So there's been a lot of talk about the service test. How would a service test fit into the idea of just adding up a bank's activities and dividing it by some measure
So
of
our kind of thought on this, and again, if you walk out of here with one thing today, it's that we have ideas, but we need other ideas to kind of bring this to conclusion. And that's why I think putting a framework out is good, because it'll spur people's thought process. Is I think on the service test, what we're thinking about is, because we want to get everything up to some kind of a dollar amount so we can potentially compare it to a balance sheet item, is that if you dedicate, let's say, 1,000 hours to your community, that we would allow you to quantify the cost to the organization and add that to that economic bucket. So if you had, in my example of 100 million, if you had $70 million of loans and $20 million of equity investments, and you spent $10 million in donations and dedicated volunteer time, that would be the 10 million, and that's how you could get to the $100 million. And we're open for ideas on that. That one's going to be a little bit more tricky because it's going to require you to do a little bit of a calculation. But I think one of the problems that people have said is we do all this service work and somebody looks at the hours and they go, so what, But if somebody looked at it and said, those hours resulted in us, spending $10 million, I think that would get people's attention.
So this would also greatly streamline the examination process.
I think so. I do. I think what we would like to get to, this is maybe my fantasy land, is that if we could get this measurement thing right, and we could ask banks to give us either quarterly or semi-annually one number, give us your total CRA invest, we could just do that comparison, and we could just kind of have a perpetual, certified that you're in compliance with CRA, subject to our validation of coming out and just checking your books and records and that the investments do qualify. I think it takes a lot of tension and stress away and allows banks and other organizations to do what they should be, is out there taking care of their customers and growing their communities.
We've heard all day about the challenges in working not just in the higher cost markets, but in the lower cost markets where the economics of making small balance mortgages are just very tough, but they're critically important to some of these neighborhoods.
Yep.
And so the question, I guess, is well, if the median home price in Chicago is twice what it might be in, say, Toledo or Akron or Dayton, and should that $200,000 loan to a low and moderate income buyer in Chicago really be worth twice that $100,000 loan in Akron?
Mm-hmm.
And so how do we sort of make adjustments for markets?
Nobody's brought that up before. I'd be interested in people's thoughts on a solution to that.
That'd be great. Well, what's the status of your process on an ANPR?
So I'm meeting with the FDIC tomorrow. It's been a back and forth process. As you can tell, I have a little bit of passion about this issue. I tell people I get up every morning trying to advance that ANPR. My wife thinks I've lost it, but I think it's really important. It's important to me, and it's important to the agency. And I would hope in the next week or so, we will make a decision whether we will release it as a sole agency or a joint agency. I hope it's a joint agency, to be honest with you, because I think that's better to have all three agencies supporting it, but I am prepared to go singular if I have to. And then they can take advantage of all the information we gather, because an advance notice of proposed rulemaking just goes out and says, here's the issues we're thinking about, give us feedback. We would accumulate all that, share that with the Fed and the FDIC, and then ultimately you either come back out with another advance notice of proposed rulemaking, what you learn, or you can move to a notice of proposed rules. And I think that whole process is 120 to 150 days to wrestle that to the ground. And then we're still hopeful in 2019 we could put forth some kind of rule that people could then, we go back out to the market and people give us feedback. So what I try to tell people is, think about that we're trying to build the chassis and transmission right now. Don't worry about the mag wheels and what kind of radio and leather seats. Just help us figure out the chassis this time around, and then we'll come back and we'll talk about all the other kind of important attributes.
Are you guys also working on revisions to examiner guidance under the current regime?
Yeah, what we've been doing is we really thought that we would have the ANPR out and would be further along with that. Naively, when I came to Washington, I tell people that I got here on November 27th, and on November 28th we started working on it. I was hopeful that like in April we would have this ANPR out, and then I ran into the Washington process, and I'm still fighting, but there is some revisions coming out on the current examination process, and I think Gravetta's been working on that, and if it's not out, it's going out tomorrow or the next day to give a better, it's a bulletin, I believe. I don't think it's guidance, I think it's a bulletin. And that's the other thing about this city, guidance has a bad connotation to it now. Because guidance, people are thinking should go through the rulemaking process as opposed to being able to give people a direction about what we're thinking. So we've started to use Q&A bulletins more for that process.
So that'll be public information?
Yes, it'll be, if it is not out today, it'll be out tomorrow. Brian says it'll be out tomorrow.
So that's great. There's news for us.
Right.
Let's open it up to audience questions. Who's got a question for the Comptroller? We see one over here and one back here. So if we can start getting mics around.
Why don't you stand up and yell?
Well, we're recording this, so.
Okay, sorry.
We don't want to miss it.
Josh Silver, National Community Reinvestment Coalition. Thank you for coming and sharing your thoughts with us today. Your ratio idea, CRA activities divided by assets, or some other measure of capacity in the denominator. Actually, in a way, I'm sort of flattered because NCRC has negotiated community benefits agreements, and that notion of a ratio is in our community benefits agreements. But I also have a caution about that. How do you then use the one ratio if you still have assessment areas? How is the one ratio compatible with assessment areas which measure performance in local markets? And the needs in local markets differ greatly. The needs in Detroit are very different than the needs in Washington, D.C. A distressed market versus a market experiencing lots of gentrification. So how is the one ratio idea still compatible with assessment areas on CRA exams?
Yeah, Josh, I don't think we have all the perfect answers for that. If you guys have used that concept, and I am aware you've used 20% of deposits with some of the agreements. So I think that's part of the tricky needle. Do you then require the institution to have some kind of minimum of a percentage of the deposits or assets in that area? I think that's one of the elements that I think collectively we need to sit around in a conference room and talk about, is how do we address that issue, that somebody doesn't say, I'm going to put all my money in Charlotte and I'm not going to do anything in San Diego, California, something like that. The counter argument to that is markets that are oversaturated, like Salt Lake City, Utah, where a lot of the banks there are just starving to be able to find product because you got a lot of financial institutions that are headquartered there, and there's very limited volume of low to moderate income activities. That's part of that threading that needle, I think, between assessments areas and trying to create simplicity from that process. But I would be open to thoughts that you have on that would help us kind of get through that window. So,
I think there was somebody back here.
I think there's one in the
one over here too. Okay.
Thank you. I work at a large regional bank, and I've been in community development lending for over 25 years.
Let's give her a round of applause.
Thank you. And honestly, for this group, I will say that one incentive for us to do and to come up with new products and to get things out in the marketplace has been, I would say, that community groups have acted as an advocacy, and the real notion that CRA got the teeth, even though I always tell my group it was like the law was passed in 1977, but it wasn't until the late 80s where knowing that a major financial incentive, which is mergers and acquisitions, which is very important to banks, could be held up because you didn't get your CRA rating, still has a lot of weight in what we do in getting us to do our best. So I do get that pressure inside the bank where, leaders will say, what does the regulators want? Why don't they give us an objective number? Why don't they tell us exactly what we should do? And that we sort of go in blind and present and then wait the 3 years. And I really can say from my 25 years experience, what's good about the blind part is that we have to do our best. And so we do go in thinking, okay, well, what do we need to do? How do we need to respond to our community? And we go in and we put our best foot forward and hope for the best. But I kind of feel like if you come up with something very objective and say do 10% here, 5% here, we will do it. We won't go much over that, but we will do exactly that. And I just wonder if that's not allowing us to ask questions, talk to our community, take the pressure from the community to try to come up with true needs assessments like we used to say what is needed in this community and how should we do our part. That's just one banker's thought on it.
Yeah. Now, in the statute, just so you know, is the requirement that in any merger, or it does require that the CRA record of the acquiring and the selling entity is considered in that transaction. Yeah.
Kristen Faust with Neighborhood Housing Services of Chicago, and thank you, Mr. I don't know what the honorific is, Mr. Comptroller.
Joseph.
Thank you, Joseph. Really for your really frank and great comments, and this is a great dialogue, and we appreciate the opportunity. So hearing what you're laying out, I just want to put forward the scenario, which I'm sure you've heard, which is that we access capital from banks every 3 years where we go out and do single-family mortgage lending. And we are making single-family mortgage loans 90% to African-American Latino homeowners. Our pool performance meets or exceeds any of the standard national FHA performance. But we have trouble accessing capital. Last time we went out, we only were able to raise $39 million when we needed $60 million. Because single-family mortgage market, the spreads are thinner. And then what we hear is, honestly, my dear colleagues in the banks, and I was a banker, why would I invest in your pool when I can get X% investing in a LIHTC deal and there's much less risk? And so we need both. We need LIHTC deals, right? And we need single-family mortgages in low and moderate income neighborhoods, in severely underinvested neighborhoods in Chicago. And so I'm looking for a CRA that encourages banks to do both and not just lump all of it into one category and the easier category, and that's my fear about more of the checklist approach.
And I apologize, you used the word LIHTC or something, and I'm not familiar with what that reference.
Low-income housing tax credits,
Oh,
so the apartment
got it.
yield.
Yeah, no, I'm familiar with those. I just have never heard that acronym used before. And can I ask her one more question? Yep. So is that usually the yield? I mean, it's risk return also, but I mean, also the tax credits. The tax credits are less attractive to the institution with the current rate. So what I'm hearing from people, less and less people are moving into the tax credits because, you know, with the lower corporate rate, it's a less, you know, you were at a big disadvantage if somebody had a 35% tax rate and a 12 or 13% state income tax, which I think Chicago does, versus, you know, a lower federal income tax rate is going to make, I think, your yields probably a little bit more attractive.
I think that is possible, that with the new laws that the yields are changing. However, I would posit that our yields are still going to be lower than.
But so's your risk.
That it's not perceived as lower risk because single-family mortgage lending went through the crisis, and
we all went through the crisis.
I know, but single-family took a bigger hit, and so the track record doesn't look quite as sturdy as the multifamily, for example. There's different asset classes, and they're all really important, but they're not equally they're not all equal risk. And so again, I'm looking.
So what you should be arguing for is the 2 times credit to invest in your product.
Sure.
That we're going into, when we're going into disadvantaged low to moderate income area and we're doing mortgages with lower returns to get people to invest in your equity fund, that should be considered like a CDFI equity investment, that you get 2 times 1 Mr. or Mr. Banker. So.
Great, thanks.
You're welcome.
Back here.
Comptroller Lloyd Brown with Citibank, and just a quick process question, but I do want to acknowledge and thank you for your efforts to simplify and clarify CRA. With regard to implementation, you mentioned that there will be a follow-up to the ANPR that may come out in 19 in terms of an effective date. If you think about a 3-year exam cycle, could you give us a sense of the guidance the banks should think about now as this process moves forward? So you're operating under the old rules, but you will be examined by the new rules that are yet to come out, point 1. And I want to use an illustration that came out from the interagency conference talking about HELOCs and the fact that many banks are not doing well now that HELOCs are a part of CRA. One banker mentioned that his bank was going to start originating $1,000 HELOC loans in order to improve their score, which doesn't make a lot of sense. And so whether it's a HELOC situation or community development lending situation, there are business decisions that need to be made now, which will be reviewed or affected under new rules going forward.
Yeah. So, you know, the classic words of wisdom are, you know, run with the rules that are in place at the time. And if we modify the rules similar to what we did with the Economic Act that just passed legislation, we've come out in the last couple of days and said we will regulate according to the intention of the new regulation. So regarding stress tests and things like that, regarding, you know, high-risk real estate, what we've basically said is we may not have the rules written for you yet, but we're going to allow you to operate as if those rules are out there. So, but in this case, I would say it's a little uncertain about, you know, when we're going to have our victory party together. So I would continue down the path, you know, with the current rules and the current philosophy, and then we'll try to make that transition as smooth as possible for you. And can I ask that? Your second question, was it that people are manipulating things to get?
No,
Okay.
They're concerned about how the CRA score would look with a product like an HELOC loan, which does not have a history of affordable products being available. So they tend to be utilized more by the affluent as opposed to low and moderate income individuals. So potentially less equity, potentially challenged credit scores,
Yeah.
again, broad generalizations. And so how do you offset that factor?
Got
No
it.
manipulation.
Got it. Okay. Bad word, bad choice on my part. Well, you know, unfortunately, part of the mortgage problem is a lot of people went in and got a mortgage at 80% or 85% loan to value, and then somebody dumped on them a home equity loan of another 15 or 20%, and then next thing they knew, they were upside down, and all that, you know, second trustees got charged off is basically what happened. So, but I don't, you know, welcome.
Mr. Comptroller,
Hello.
my name is Bobby Salgado. I work with MUFG Union Bank.
I think
Do
I
you
know that bank.
Yes, you do. And I have 2 points to make. One is a comment, one's a question. Let me start with a comment. So, you know, you were at the Hill today. I guess you were making a presentation before
I
Senate.
wouldn't call that a presentation. Wrestling match.
Okay. So, you know, we quickly got notification of some of the things that you were saying, and there was a point that was made about the mortgage lending and being able to, you know, get credit for it under CRA if it gets sold several times. I guess, you know, the word for it is churning, right?
Uh-huh.
And so we started talking about that amongst ourselves really quickly, several of the banks, and we got really worried pretty quickly. And I was talking to Julius, you know Julius, and
Only 20 years probably, or 25, something like that.
and Julius is my boss. And so Julius and I disagreed on that. You know, he thinks it should go one way, and I think it should go another. But in hearing what you had to say just a minute ago, saying that maybe, you know, there would be some kind of a compromise where a bank that gets to purchase a loan or sell a loan one time will get CRA credit, and then it stops there.
Mhm.
It's a good compromise. And I think that I just want to give you my appreciation for the approach that you're using in being rational-minded and, you know, being open to whatever, you know, you hear from different perspectives. Anyway, I wanted to say
Thank you.
that's a good thing. So so now Julius is not going to fire me. And the question I have for you is about strategic plans and special designations. And so after all of this is said and done, all the changes are made, are you envisioning that those special designations are going to go away? Because I don't know if you know or not, but we have a sort of a hybrid CRA program. Our retail side is all under large bank. Our wholesale offices in 5 different markets are under one strategic plan. And so it's a bifurcated CRA program. So those of us who have strategic plans or a wholesale designation are wondering, is that going to go away?
So in the ANPR, you'll see we ask you that question.
Oh.
So we ask you, should we continue to use plans like that? And then there's like 10 other questions that are underneath it. And so again, we don't have all the answers. We want to understand how, you know, do people see the value of those? And if they see the value of them, what is the value? And then does it work for the institution? I think is one of the key components. And there's all kinds of variations of those. You know, if you think about it, there's some entities that have a business model that doesn't allow them to do certain things. Like if you're only focusing on small business lending, it's very difficult to get the consumer side of CRA, right, you know, enough volume. So people have strategic plans associated with that. And we asked the same question about strategic plans. You know, is there applications of that? Where are those applications they think should be there? And then, you know, what should that look like in the future? So.
Thank you.
Jim Matthews with Capital One.
Hey, Jim.
And thank you for being with us today and also for making CRA your top priority.
Thank you.
As many people have said, it's well overdue in terms of having this conversation. I just wanted to go back to one of Kirsten's points earlier, though, and I'm hoping that this will probably be part of the ANPR process as well. But today, under the CRA examinations, you can kind of break it down into two broad categories as well. There's a lot of quantitative analysis, but there's also the qualitative component. That is much more subjective, and it's one of the things that I think slows down the process. It's one of the things that makes it more challenging for examiners who have to apply their judgment. Makes it difficult for bankers as well. But I'm hoping that we'll be able to develop some way to kind of change that qualitative aspect into a quantitative measurement, very similar to the multiplier that you suggest, because that's really important. I think banks, as you know, have limited resources, and when they're making these investments in communities, they want to be sure that they're doing things that are really impactful. Right. We've talked a little bit about, banks that trade these MBSs. I don't think that that's, the standard practice for most institutions and most large institutions to kind of get to where they need to be from a CRA perspective. They really are committed to trying to have positive impact in the communities. And so I'm just hoping that that will also be part of the ANPR process. How do you change those qualitative aspects into something that's quantifiable that can be added into that measurement?
Thank you for your point. One of the big complaints that I hear often is, I did all the same things I did 3 years ago, and the new examiner comes in, and then all of a sudden I go from one category to excellent to satisfactory, and I point out, how did that happen? And, the standards haven't changed, the process hasn't changed. We have heard that feedback.
We have one more question, and then we're going to wrap it up.
Hi, David Applebaum, Bank of New York Mellon. We are overseen by both the OCC and the Fed.
Lucky you.
So I was just wondering how much dialogue occurs between the two agencies, because sometimes we get one thing approved on one side but not on the other, and maybe you can just tell a little bit about.
Randy Quarles, who really represents the Fed and the banking side, is a wonderful guy with great industry experience. And I couldn't be more pleased to have him in that role. He's a great partner. And then Yelena McWilliams just was sworn in as the head of the FDIC. Prior to that, Marty was in that role. Every week we have a conference call amongst the three of us, and then once a month we have lunch together. And it's an open agenda on things we walk in to talk about, either they're occurring in our industry or our agency or with our banks, or rules or things that are being proposed. And I really think the momentum is incredibly strong. Most of you wouldn't be touched by the Volcker rule. That thing flailed around for about 5 years, and really in the course of about 3.5 months, we got the Volcker rule done, and now have a notice of proposed rulemaking out. And I think that's just the kind of future. I really believe if you have bankers who've dealt with these things, in these agencies, we can help, bring a, real life market experience to that stuff, and not increase risk or not make it easier for banks, but just think through the process of how do we get these things done that make sense. And I think we have the right regulators in place now to make that happen.
So I want to thank the Comptroller,
Thank
Joseph.
you.
We really appreciate it.
Thank you. It's my pleasure. Thank you very much.
And I just have a few more people to thank before we drink. I want to start by thanking our sponsors and our lead sponsor, PNC. They've been terrific, as have all our sponsors. I want to thank, of course, our board and our sustaining members who keep our organization going. Without you, we would not be here today. I need to thank our partners on this conference, the Center for Community Lending, which is a NAAHL affiliate, as well as the National Housing Conference and the Turner Center. It was a really good partnership, and we hope to do more of that going forward. I want to thank Sarah Olson and Cherie Sinclair, the NAAHL staff, who made all this work remarkably well for such a small team. And I want to thank all of you for really making this not just a bunch of talking heads, but something really interactive and dynamic. If you learned something, if you got something out of this, we hope you'll come back next year. And we hope you'll tell your friends and have them come too. And with that, we're adjourned. You can... Our reception is in the First Amendment Lounge, so you go out any of these doors, go down past the restrooms, and you'll find the lounge there, and we'll see you over there in a moment.